strongly believe one of the best things that you can do as a long-term investor is reevaluate the situation when new details come out. So that's what we're going to do in this video. I'm going to go over how today really changes things for AMC and for the broader markets. Now, take this with a grain of salt because we just got new information. Information is subject to change month by month and, obviously quarter by quarter. But unfortunately, the writing's on the wall. Now, some people are going to love this. Some people are going to hate this. But I do think it is vitally important to do this nonetheless. Because, take a look at BB, right? BlackBerry. If you were buying BlackBerry in the early 2000s, say 2003 at like $5, $4 per share, you were rewarded nicely by 07, 08. Because why? Well, everyone was buying their products. Everyone thought their products were, the next big thing. What happened at the same time? The iPhone. Everybody hated on the iPhone. Nobody thought that was going to be successful. But if you could identify that, the shift in consumer behavior, even if you were a little bit late, even if you noticed this by 2010, right? 2010, and BlackBerry was a $70 so stock. Even if you were to sell then, you would be much better off than now if you had held the stock for the next, 15 years almost, and the stock's $2.70 today. I think it's vitally important to assess the situation if things change or not. Now, specifically with AMC, it's not like AMC is this big fundamental trade that everyone, needs to look at. What's really going to change in the movie theater industry, right? Probably not much over time. But even in a trade, it's important to assess whether or not the situation has gotten better, worse, if things are, helping AMC now or hurting AMC now. So we're going to do that here in this video. Hit the like button as well as subscribe to the channel and timelines. Does the new information we got today really affect AMC's timeline? I think that's important. Your time is your money. So as far as these things are concerned, the new information we got today was one of the hottest jobs reports that we have seen in the past 2 years. The U.S. economy added 353,000 jobs in January. This was much better than 180,000 as per the estimate. Last month, the jobs report was revised 117,000 job ads to over 333,000 job ads. You can make the argument right now that the economy is officially accelerating, not decelerating, accelerating. And that's interesting because if you think about this recession that we were supposed to go in for a while, if you think about everyone that was flushed with this excess capital and where that capital went in the business structure, at first, it was in wearables, your Apple Watch, your new tablet, your new phone, your new computer. That's seen the boom. That has since seen the bust. You're now back to normal levels for wearable products, for electronics, for TVs. It's kind of just where it has been kind of on its same trajectory, right? You're no longer seeing a big boost there. So what's being hit now? Manufacturing. What could be hit in the future is leisure, travel, hospitality, as people do run out of money, as they have ran out of money, and that gets back to normal now. We're still seeing elevated levels of travel, leisure, hospitality. You can see that in Royal Caribbean that just reported earnings saying like 40% of 2024 is already booked out for the company. So that was, some good news on that front. That is technically the segment that AMC is in as well. Entertainment, we'll just call it. And AMC's segment is a little bit different. You're not taking 1 or 2 vacations a year. You're going to the movies, whenever you want, right? It's down the road for most people. So I think AMC fundamentally is fine. It will be fine. It will do just okay. But if you think about, again, everyone getting flooded with cash, where that money went in the economy, you're going through this rolling recession, and you don't have that central catalyst that is pushing everything into a recession at the same time. So that's why you're not seeing the economic data actually bad. That's why you're not seeing company earnings all at once turn bad, right? Last year was really the recession, if you will, for Apple, for Meta, for some of these other companies where their earnings were just not in a great place. They've since started to come back, as we can see from Meta, up 22% today. So I think that's pretty interesting if we think about it in that context, because that means the economy could actually accelerate here. The economy is indeed re-accelerating here, and we're not heading into a slowdown. That means most likely the Fed is not going to be cutting rates. If they do, it's going to be simply because inflation comes down. Now, in that scenario, if the economy does reaccelerate, you can make an argument that some of the inflation gains that we have seen, some of the success in fighting inflation that we have seen, is going to get a lot harder here, as there is still just more money out there in the system. And it could take a longer period of time to see that money get reset into different areas. What I mean by that is, money gets put long-term in the house or into stocks. We've already seen that. But there's still more money out there now than there was before. I don't think inflation is going to reaccelerate in a meaningful way, but if the economy does not see weakness, inflation typically correlates to the economy, right? Especially once you start seeing inflation. Once you start seeing inflation, a good economy usually leads to more inflation, and a bad economy usually leads to less inflation, sometimes even deflation, right? You never get deflation during a good economy. That's basically unheard of in economics. So if, as some people expect, you could actually see deflation, that's not going to happen if the economy is doing well. Now, you don't want to see deflation anyways, but I think this really means we have to reassess our expectations for rate cuts. It's possible that if inflation does not continue to see some meaningful progress in going lower, you may not see a rate cut in 2024. I know I'm very early on this and saying we might not see a rate cut. That's very much up for interpretation. You could see 1 rate cut or 2 rate cuts, but at this point, I am not going to make the bet that you're going to see 5 or 6 rate cuts as the markets are, currently pricing in. Let's go ahead and take a look at what markets are pricing in for Fed policy. So for December, we're currently pricing in 1, 2, 3, 4, 5 rate cuts. You're not going to get 5 rate cuts. You're not. It's not going to happen unless you see some kind of deterioration, black swan kind of event. It's just not going to happen. Okay, guys. And that's a little unfortunate for a lot of people because, small mid-cap stocks, most of my portfolio has priced in 5 rate cuts. Even if you don't think it has, it has. Markets are expecting 5 rate cuts, if not 4, if not 3 at the bare minimum along the lines of the Fed. If we only get 1 or 2 rate cuts, that's an epic problem for a stock like AMC. And I think this is going to put a lot of pressure on those CPI results, because if CPI does not fall, as much as expected, like last month, for an example, inflation came in hotter than expected, slightly. it wasn't seen as a super negative because we're like, Fed's still going to cut rates in March, 5 or 6 rate cuts this year. We don't care about one hot inflation report. The markets are going to start caring about that. And like we seen last month, inflation was a little bit hotter than expected. If it's a little bit hotter than expected next time and the time after that, pretty soon you're going to be pricing in the first rate cut in September. And that's, again, a big problem for AMC. Now, why is that a big problem? I think that's the important part to really point out. Because, number one, if rates stay higher for longer, that means the $6 trillion in money market funds is going to stay there for longer. And if that money stays there for longer, that means it's not coming into stocks. There's no rush to get into stocks. If you can get 4 or 5% on your money, if you have a lot of money, that's what I would be doing. If I had, $50 million, $100 million, a good chunk of my money is going to be sitting in a money market fund or, in the short end of the curve at the bare minimum. Because, why would it not, right? You buy treasuries from here. If inflation does fall more than expected, cool, you get some capital gains on your bonds. If it falls faster than expected, or if it stays higher for longer, then maybe you don't get as much capital appreciation, but you just get a 5% yielding bond in 2 years. You cash out, you get all your money back, you get your return, and boom, all is fine, all is dandy. So the higher rates stay for longer, the longer it's going to take to get more money back into our markets. The problem with stocks right now, the problem with a PayPal, a Fubo, a SoFi, these stocks that are so far under their 52-week highs, it's ridiculous. They're beaten down. Look at a PayPal. It was $300 in 2021. It's $62 today. The reason for that is not because PayPal's business has slowed or is not good or none of that. It's because there's no money in our markets. And if there's no money in our markets, that means nobody's going to buy an AMC. It's just the fact of the matter, right? So I think this does negatively impact AMC's prospects of a short squeeze. You want to see capital rushing back into our markets if you are an AMC investor. That's what you want to see. Without that, I don't think there's going to be some kind of euphoric, market, right? Now, you want capital to come into our markets, you want rate cuts, but you don't want a terrible economy. That's why inflation data that we get will be so vitally important for markets, but specifically for AMC, and should be vitally important for you as investors in AMC or traders in AMC, because you need to see inflation come down at this point. Again, the Fed made it very clear. We can see a strong labor market, a strong economy. That's fine as long as inflation comes down. The two, though, typically don't happen hand in hand. You typically don't see an economy reaccelerating and inflation decelerating at a rapid pace. That usually does not happen. Correct me if I'm wrong, if there's been any instances in history where that has actually happened. But typically, at least a decelerating economy leads to decelerating inflation, not vice versa. So let me know what you think about that down below in the comment section. I do think at least by the end of this year, if not 2025, you will get more capital coming into our markets, because at that point, you're either going to be full Paul Volcker by Powell if inflation does come back up again, or you're hopefully going to see some serious progress on inflation, and by then starting to get some rate cuts and more rate cuts priced in, right? But in the near term, we do have a bit of a problem, with markets pricing in 5 rate cuts and markets at all-time highs, when it just does not look like that is going to happen, not even remotely close. So let me know what you think down below in the comment section. But let's get into some of the Ortex data here. You do have 11.13% short interest of free float. The higher this goes, the better, because you want to see, a high number here. If you're a new trader looking to trade AMC. Now, I do think ultimately, again, I should point this out, the big upside for AMC comes when Adam Aron says, hey, we're not going to dilute shareholders anymore. That's when things get really interesting for AMC. That's when I think things can get much more squeezy, much more volatile to the upside. There's no timeline to when that is going to happen, but when that happens, you want to see the short interest as high as possible. I think the short interest is 200+% at least. Who knows? I could be wrong there, but the higher it looks on Ortex, the higher it looks to other individuals, the more individuals might opt to make a trade in AMC when AMC does see a big update, like a 10% update. You know what people are going to do? They're going to go look at what the short interest is and see if there's a possibility of a short squeeze or not. AMC does have a short interest value of $113.2 million. Days to cover at 1.5, 27.88 million shares that are currently sold short. Shares out on loan 28 million. Cost to borrow 1.13%. Utilization of 42%. And a short score of 61.11 out of 100. Cost to borrow max at about 1%. Option activity for the day today. You didn't see much from hedge funds or institutions. One trade that was a January 17th, 2025, $1 put, worth about $28,000. So not a lot of option activity at all in the market for AMC today, which makes sense. AMC hitting a new multi-year low today. It doesn't seem like a very good opportunity to be going short on AMC or buying puts on AMC. And honestly, buying calls on AMC doesn't make sense either until Adam Aron gives us a commitment to not diluting shareholders. So I think that's something, hopefully comes soon. But as far as, if it's going to happen at all, that's still an uncertainty. That's still up in the air. Now, the latest AI investor sentiment survey reflects what's going on in our markets. 49.1% of investors are bullish, 26.4% are neutral, and 24.5% are bearish. So pretty much everyone is bullish in our markets. And that definitely does show at this point. AMC down about 2.22% here on the day today, hitting a new multi-year low at $3.94 per share. It does not look good, guys. Unfortunately, it does not look good, and there's not too many good things to say right now, unless we get really good earnings somehow, unless we get a commitment not to dilute shareholders. I think it's nothing much is going to happen for a period of time. So let me know what you think down below in the comment section. Hit the like button as well as subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.